Hello and welcome back to our second lecture video dealing with Chapter 4, Understanding Financial Statements. So in this video, we're going to go ahead and we're going to look at the income statement. So in this video, we're going to describe the difference between a single step and a multi-step income statement. Now, up to this point, we have seen the single step income statement, right? We take our revenues, we subtract out our expenses, we end up with net income or net loss. That's the single step. Super duper easy, right? But now we're going to get a little bit more detailed, and we're going to look at the multi-step income statement. Okay, so what we have here is an example of multi-step income statements. If you'll notice, there's a lot more steps in this, right? We have to calculate a number of things. Okay, we break down our expenses into operating expenses. We calculate things like income from operations. We add or subtract any other income or expenses that we may have. Then we end up with, income before income tax. We subtract out our income tax. Then we end up with net income. Totally different than what we did before, right? Before we said, what are my revenues? They're X. Okay. What are my expenses? Well, we have these 10 expenses. Let me add them all up, and my total expenses are Y, right? Subtract revenue X minus total expenses of Y. We end up with either net income or net loss. Okay. So now we're going to get a little bit more detail oriented. So if we look here, we have a difference between the income, or we have a difference between the merchandising company and the service company, okay? So what we're doing here is we're taking a multi-step income statement, which is nothing more than revenues and expenses presented in distinct categories, right? And this will help financial analysts. It will help them to analyze our income or our profitability, okay? Now, we're going to focus in on the merchandising company, but before we do that, notice the difference between the two, right? Service companies, by design, right, do not buy goods and then turn around and sell them to somebody else. So a service company will not have cost of goods sold. The merchandising company, on the other hand, does have cost of goods sold, so we end up with a gross profit from a merchandising company. So what exactly is gross profit? Well, it's net sales minus cost of goods sold equals gross profit. So that's pretty important. That's definitely something you're going to want to know, right? Okay, so let's focus in now on the elements of a multi-step income statement looking at a merchandising company, okay? The first thing we need to notice is we start off with net sales, right? Before this, meaning last chapter when we were doing the income statements, we just said revenue, right? Well, now we have a new thing called net sales. What exactly is net sales? Well, net sales is the amount that is left after we have subtracted sales returns and allowances from our sales, okay? So think about it this way. We start off with sales. We subtract out sales returns and allowances. We end up with net sales, okay? We will look at sales returns and allowances and sales discounts in our next chapter, okay? So right now, it's just important to understand what are net sales, okay? So think about it this way. A merchandising company, they sell merchandise to us, right? So let's say we're going to, let's dream big. We're going to go to Nordstrom's and we're going to buy a pair of, and I know we have mostly females in here, so that's why we're going with this. So sorry, Sean. Louis Vuitton shoes, right? The red bottom, right? Red bottom shoes. Okay, so we go to Nordstrom's or whoever, and we buy a pair of these shoes, right? Now, Nordstrom knows that, there's a good chance that these shoes are going to be returned to us, right? So they're going to make a sale. There's a probability. They don't know what it is. They have an idea that there's a chance that those shoes are going to be returned to Nordstrom's, right? Maybe we don't like them. Maybe they don't fit right. Maybe they were impulse buy. We bought them and then, a couple weeks later we returned them, all right? So the point is that we have this new account called sales returns and allowances. This is a contra account. It's a contra sales account or a contra revenue account, okay? It's very, very similar to accumulated depreciation, right? Remember, accumulated depreciation was the contra asset account to equipment or to building. Sales returns and allowances is a contra revenue account. So we take our sales, then we subtract out that estimated sales returns and allowances to end up with net sales. Okay, we'll look at this in a lot more detail in chapter 5. Again, right now we just got to know what it is and how we calculate net sales. Okay, so the next thing we need to look at is once we have our net sales, we subtract out our cost of goods sold. We know what cost of goods sold are. That's the cost of merchandise that we buy from a wholesaler, then we turn around and sell it to somebody else to make a profit, right? That cost of goods sold is that cost that we pay to the wholesaler, okay? But what's really important here is we have this thing called gross profit on sales, okay, or gross profit. Gross profit is net sales minus cost of goods sold. Now, why is this so important? This number is so important is because this is the amount that's left over after we have deducted cost of goods sold, okay? So it's part of profit that's left once we get rid of the cost of goods sold. Another reason why it's so important is because that gross profit is what is left over for the company to cover their operating expenses, right? What are our operating expenses? Well, operating expenses are any costs that we incur to operate our company. We got to pay wages. We got to pay rent. We got to pay insurance. We have supplies expense. We have insurance expense, right? Those are our operating expenses. Okay. So once we deduct out our operating expenses, we have what we call income from operations, okay? So income from operations is basically the income that we've earned from operating, right? We've taken our gross profit, which subtracts out our gross sales. We subtract out our operating expenses. And again, those operating expenses they're related to what our core business is or what our primary operating activities are, okay? We're Nordstrom's, right? We got to pay the utilities. We got to pay the heating bill. We got to pay rent to the mall. We got to pay insurance, all that good stuff, right? So once we subtract out those operating expenses, we end up with income from operations. After that, we're going to factor in any other income and expenses, okay? This means any other income that we made or any other expenses that we've incurred that are not part of our primary operations, okay? This income and expenses is not part of our core business, okay? So what are some examples? Well, maybe we have interest income, right? Maybe we invest our money, right? Remember those short-term investments? We're going to get income from that, interest income or investment income. That is an example of other income and expenses, right? Maybe we have interest expense. Maybe we have to pay interest on a loan. Interest on a loan. That would be an example of other income and expenses. Maybe we sold some property, right? Or we sold property, plant, and equipment. Well, in that sale of that property, plant, or equipment, we may have a gain or loss. Our core business is not buying and selling property. Our core business is selling merchandise. We just so happened to close a store and sold the building, or had equipment in a store that we sold and we sold that equipment and we have a gain or loss on that. Okay. So that in a nutshell is the multi-step income statement. Okay. I get it. This video was pretty dense with material, right? I understand that there's a lot going on here and there's a lot we need to know. First step is to recognize the difference between merchandising company and service company, right? I think that's pretty easy. I think if we just think about, well, what a service company does and what a merchandising company does, it's pretty easy to say, well, yeah, merchandising companies are going to have that cost of goods sold where service companies not, right? We talked about net sales, right? And it's very important that we understand how we calculate net sales. We introduced this concept or this account called sales returns and allowances. Just for right now, you just got to know that it's a contra account, contra sales account, or contra revenue account. So that means it has the total opposite balance of revenue, right? How do we increase sales or revenue? We increase it with a credit, decrease it with a debit. The sales return and allowance is increased with a debit, decreased with a credit, and debit's a normal balance side. Okay. So we got to know, what that sales returns and allowance is, how to calculate net sales. That's it for now. We'll get into it a lot more in a lot more detail in Chapter 5. Gross profit, we got to know what it is, why it's so important, right? Well, gross profit from sales is what's left after we subtract cost of goods sold from net sales. Okay, why is it important? Well, we already said it's what's left after cost of goods sold have been deducted, but it also is what's left over to cover those operating expenses that we're going to have. Those operating expenses are expenses that are related to our core business activity. Selling merchandise. That's pretty much it, I guess, for our merchandising company, right? We talked about other income and expenses, right? That's any other income that we have, any other expenses that we have that we either incur or generate from activities that are not part of our core business activities. Okay? So, which of the following is not part of a multi-step income statement? Well, if we look at it, current assets definitely jumps out at us because we talked about current assets in our last video. Current assets belong on the balance sheet. It's not an income statement item. Okay? When we come back, I just want to break it down a little more for you guys, or the videos, try and keep them topic related. When we come back, we're going to go back to the balance sheet, but we're going to look at ratio analysis. Okay, we're going to look at things like liquidity, and we're going to look at things like solvency. So tune back in for that one. I think we just did a good review of what you need to know coming from net sales, calculating the multi-step income statement, net sales, gross profit, operating expenses, the idea of other net income and expenses. Okay, so tune back in for our next video where we get into the really fun stuff and we get to look at ratio analysis.